is dealing with completing our accounting cycle. So we're going to talk about expanding our balance sheet, and the only way that we're expanding it is that we are doing something called making it a classified balance sheet. So what's on your balance sheet is not changing. It's still your assets, your liabilities, and your equity. We're now going to classify our assets and liabilities into two different classifications. So for assets, the first one we're going to have is what we call current assets. So your current assets are going to be any asset that you expect to use, sell, or convert to cash within a year or less of that balance sheet date. So that's always going to be our cash, our accounts receivable, our supplies, prepaid insurance, prepaid rent. All of those would be considered current assets for our business. Our second one would be for property, plant, and equipment. And property, plant, and equipment is exactly that. Any property, meaning any land, any plant, meaning any building or factory, and then any type of equipment at all. So your equipment, your machinery, your vehicles, all of that is going to be included in that property, plant, and equipment section, as well as the associated accumulated depreciation. And something that I will remind you of here, I had mentioned it briefly before, is that the only long-term or fixed asset that we have that does not get depreciated is land. So a piece of land, we leave it at whatever value that we paid for it. So if a company has land, it's always going to be listed first in this property, plant, and equipment section. After that, we would list whatever we have in terms of assets. Followed directly below each asset would be their accumulated depreciation. So if I have these three assets that we see here, I'd list equipment, right below it, the accumulated depreciation for the equipment, machinery, less the accumulated depreciation on that machinery, buildings, less accumulated depreciation on that building. We want to make it very clear to anyone looking at our financial statements how much we paid for each one of those long-term or fixed assets and how much we think we've eaten away at that value. We want to give everyone a pretty clear picture of what the real true values are of each one of those assets as of that balance sheet date. So two classifications for assets. Current assets, anything that we plan to use up pretty quickly over time. Property, plant, and equipment, anything that we plan to have around for a while, and including all of that accumulated depreciation. Liabilities, we have current liabilities and we have long-term liabilities. So current liabilities, just like current assets, are going to be any liability that we have to pay back within a year or less. So always your accounts payables are going to be in there, your wages payable, your taxes payable, interest, unearned fees, all of those things would be considered current liabilities for you. Notes payable can be, depending on how long we have to pay back that note. We also can have something called the current portion of notes payable. So if I have a mortgage that's 30 years, that's going to be a long-term liability. I have 30 years to pay back that entire note. However, every year, I'm going to have to pay a certain value of that note back. So let's say my mortgage every month is $1,000. So every year, $12,000 is going to get pulled into my current liabilities because I owe that $12,000 on that note in this upcoming year. The remaining balance would be considered a long-term liability for us. And again, long-term liabilities, anything that we have over a year to pay back. And when you're doing your homework, they're always going to indicate for you if there's a notes payable of when that note payable is due, so that you'll know whether it belongs in your current or your long-term liabilities. The other part of Chapter 4 is dealing with what we call the closing process. So again, part of our accounting cycle that we have, we do our normal business transactions, which you did in Chapter 2. We do our adjusting process, which we do in Chapter 3. And then we do the closing process. And the closing process only happens one time a year. It happens at the end of the company's fiscal year after the financial statements have been prepared. And what we do is we close out what are called temporary accounts. So we have permanent accounts and we have temporary accounts. Our temporary accounts, which we'll talk about in a minute, are everything that we're going to see on our income statement. Our permanent accounts are every single account that you have on your balance sheet. So all of your assets, all of your liabilities, and your capital account of your owner are permanent. Your permanent accounts do not get closed. So that means when I go to bed on December 31st and I own my home and my car and I have money in my bank account, all of those things are still there when I wake up, hopefully anyways, on January 1st. Same thing with all of my liabilities. If I go to bed with $3,000 charged on my credit card on December 31st, unfortunately, when I wake up on January 1st, that $3,000 is still there. So that's what we're talking about in terms of permanent accounts. The balances, the ending balance rolls from 1 month to the next and 1 year to the next. Temporary accounts do not do that. Temporary accounts, their job is to track information for 1 fiscal year at a time. And then we reset, we kind of hit that reset button, set it back down to 0 and start all over again. So all of your revenues, all of your expenses, and your owner's drawing account are our temporary accounts. And the easiest way to remember which ones are your temporary accounts is the acronym RED. RED is temporary. Revenues, expenses, and drawing are your 3 type of temporary accounts. It allows us to kind of reset everything to see how we're doing year to year. Because if you looked at some income statement and their income statement showed that they had $10 million in net income, and I asked you, well, is that good or bad? You're probably going to tell me it's good. But if that's just an accumulation of the last 5, 10, 15 years of being in business, we would have no idea if that business is growing or they're kind of falling off the map here. So every year, we're going to close out those revenues and expenses and say, okay, how much did this company do in revenues this year versus last year versus 2 years ago, 5 years ago, and what was their net income? That way we can do a comparison. So really, when you think about doing your closing entries, think about your statement of owner's equity. On our statement of owner's equity, we said we increase the a capital account by that net income or decrease it by the net loss, and we reduce it by the drawing. We're basically going to journalize that process through our closing entries. That is what we're going to be doing. So to close out an account, we are basically going to make the balance in those accounts 0. And it's very easy for us to do that. All we have to do is the exact opposite of whatever balance we already have. So our first closing entry, there's only ever at the very most 2. At the very least, there's going to be 1. Our first closing entry is going to close our revenues and expenses and transfer that net income or net loss to our owner's capital. Our second closing entry is going to close that drawing account, which also gets closed to the owner's capital account. So again, easy thing to do is all we have to do to close an account is the exact opposite of whatever its balance is. So for example, my revenues have credit balances because that's the side that increases the account. So if I want to close it, I'm going to debit it for its balance. My expenses all have debit balances. That's their normal balance because that's how we increase expenses. So to close them, we're going to credit them for their existing balance. So that's how we're going to close out our accounts at the end of our period. So let's do this. They give us some information about our company. They tell us that as of December 31st, these are the balances that we have in our capital, our drawing, our fees earned, and then all of our expenses. And they want us to journalize the closing entries. So on December 31st, we're going to close out these accounts. Again, something to pay very close attention to. Capital does not get closed. It gets affected by the closing entries, but we do not close the account. So over here, I've kind of done a quick little statement of owner's equity. So let's put in some information that we know. We know that we have $9,556,000 $300 as Carrie's beginning capital. There was no additional investments, so we don't have to worry about that. Our net income or our net loss? Well, she had $1,878,400 in fees earned, and we subtract away all those expenses. That means she had a net income of $285,200. She withdrew, they told me, $80,000. So that net increase in her account would have been $205,200. So her ending capital balance should be at $9,761,500. That's the amount that we would carry onto our balance sheet, right? Because we know the last number from each financial statement is brought down to the next. But it's telling me here that her capital account only has $9,556,300 in it. It doesn't have that $9.7 million. So I need to do something to update her capital to reflect that and to reset my revenues, my expenses, and my borrowing accounts back to zero. So revenues increase with credits. So if I want to make them zero, I'm going to debit them. My expenses increase with debits. So if I want to make that account zero, I'm going to credit it. Same thing with my rent expense. Same thing with my supplies expense. And my miscellaneous. So we just closed my revenues and my expenses. So 2 out of my 3 that make up that term red. So we've closed those out. But we know some very important rules when it comes to journalizing. And the first rule is at least 2 accounts have to be involved. Well, we definitely have more than 2. Any account that's being debited has to be listed first. We have. Followed by any account that's being credited. We've done that. And our debits and credits have to equal. Well, I got 1.8 million on this side. And in total, I only have 1,593,200 on this side. So my debits and credits don't equal. But we know that they don't equal because we have that net income. And what did that net income do to the value of my owner? It was a positive. It increased the value of Carrie Buckner Capital. So we're going to increase her by that net income amount. So now on my credit side, I have 1,878,400. Have that same on my debit side. Also, we got to close our drawing account. So what does drawing do to the value of my owner? Well, it reduces her value. So if my capital account increases with a credit, that means it decreases with a debit. So we're going to close it by the drawing amount, that $80,000. Carrie Buckner drawing increases with a debit. So to close it, we're going to credit it for $80,000. So now if we think about Carrie Buckner Capital, she started with that $9,556,300. So as of, let's say, January 1st, we credited her account for $285,200 as part of our closing entry. And we debited her account for $80,000, also a closing entry. So when we do our math here, Credits and credits, we add together. Opposites, we subtract. Her ending balance now matches her ending balance that we calculated on our statement of owner's equity. So we're literally journalizing what changed the value of our owner by doing our closing entries. We're transferring that net income or that net loss, and we're also transferring that drawing effect to our capital. Because remember, the accounts that are on our balance sheet, which are my assets, my liabilities, and my capital, are my permanent accounts. I want this ending balance to be our beginning balance for the next fiscal year. Let's do another one. We have Felix. They give us some information about him, and we're doing this as of April 30th, they tell us. So before you ever do any closing entry, always calculate whether you had a net income or a net loss. So he had $356,500, $283,100 in wages, $56,000 in rent, $11,500 in supplies, and $13,000 in miscellaneous. That's a negative, which means he had a net loss. This is important to know because remember, my rules of journal entry is that we have to record any account that's being debited first. So fees earned, we're going to debit it for that $356,500 because normally it increases with the credit. We're doing the exact opposite to close it. Back here, we increased her capital account because it was a net income. But remember, if it's a net loss, it's going to reduce her value or his value. So we are going to debit Felix Godwin capital for that $7,100. We don't put in a minus sign because we know that the debit is automatically going to reduce that capital. We have our wages expense being credited for that $283,100. We have our rent expense for the $56,000. Supplies expense for $11,500. And miscellaneous expense for $13,000. And again, double check. Do your debits and credits equal? I have $363,600 on this side. I've got $363,600 on that side. And we're going to debit Felix Godwin capital again for the drawing value, that $10,500. And we're going to close out his drawing account by crediting it for that balance. So again, I can't stress enough that our capital account does not get closed. So you'll notice in my closing entries, you don't see that $9 million anywhere, or you don't see that $643,000 anywhere. We do not close out our capital account, but our capital account is affected by our closing entries. And what we're doing is we're transferring what we see impacting our capital balance on our statement of owner's equity. We're transferring that over into a journal entry to update our capital account.